less than 2 months. Then the strike price. How do we choose the strike price? I already mentioned it before. So like there are certain parameters you can sell below. So if the price is $10.50 now, you can choose what? $10 strike price, $10.50 or $11. Which one you're going to choose based on your like long-term strategy? Do you want to buy the stock? If you want to buy the stock, you put $11. That's definitely put to you. If you're conservative, you choose $10 strike price. If you're neutral, you put $10.50. You kind of don't bother if it's going to put to you or not. You know what you're planning to do after that, you're choosing $10.50. Okay, so that's the strategy. Probably the highest return, it would be if you choose in the money, so it's above the current price, because you collect not only the premium, time premium, but all the intrinsic value, all the difference which is now have this particular stock and option. Okay. So let's have a look at how it's done. For instance, that was what company? Nike. Okay, Nike 52.50. So we can do at the money. You can get $1.74. That was last year's slide. Okay, and if you choose $51, you can get 87. So it's less. And if you go for $55, you get nearly $3. What will you choose? Okay, you don't know that this in a year time is going to be $70. But you know that this company is good, this company is solid, it's constantly growing, it's make money, and right now it's undervalued. That's why I showed you, because at that time I analyzed it was undervalued. So, and that's why you're choosing 1, 2, or third strategy. And here, the profitability. So if you annual return based on no margin, so you don't risk, you promise that you buy at $55 and you have $55 in your account. That's the key, you don't use margin. So that's your profitability here. 20%, 39%, or 84%. 64, sorry. That's what you can make money. Based on just selling put options if the share price ends up above strike price. That's how we this profit calculate. I use actually this spreadsheet for myself every time when I assess my potential reward. So that's how I do it. And here I can see the break-even point. So where is it? Cost of its exercise. So that's how the company costs for me. So if I have to buy it, so the share price is 52.59, but I can see here it's 50.26, 51.30, and here's 52.18. So it's still below the current price. So even if shares put to me, I bought them like cost of buying them cheaper than if I go and just buy shares in the market. That's why I prefer enter any long position with put options if I can. Okay, so then you have to have this in mind, this type of table, plan A and plan B. And it doesn't really matter which strategy you use. And if you don't have this part, please do develop it. Sit down with yourself and think, okay, what if I'm wrong? What if whatever security I'm entering position now, what if it goes against me? What do I do? Majority of losses, traders who loses money, I always ask why. They say, basic thing, didn't put stop loss, or didn't do some kind of protection, hedging strategy, etc. So guys who think about that side first, they always make money in the stock market. So plan A. So if I'm right and the stock price going up, so what can I do? Two things. I can just sit and wait, do nothing, because if it goes above strike price, what happens? It expires. So I just keep the cash and that's it. But another strategy, what can I do? What did you do last night? You bought it back. So you sold it at certain level and then you buy it back. And you make this decision when to buy or just keep it going. Why do you think, what's the difference?
It depends if you want to keep stock or to get stock or
it's not going to put if you see that it's running up. Yes, of course it can go down. You can, first of all, it's protection kind of. You collected your profit, that's it. You exited the trade. You don't have any agreement.
Well, the earnings report was tonight, so I'm not risk.
Absolutely, no risk. So you exited the trade, you cashed yourself. But what I pay attention to very often. So for example, I sold the put today, and 3 days later, Until expiration, it's another month, another 3.5 weeks. And within 3 days, I have only 25% of premium left. So because it's rallied up, I can exit this position for 25% of premium which I paid. Do you think it makes sense? Yes, definitely. But if it happens day before that, and I know that day before I can exit 25%, so I think maybe for 1 day I'll wait and collect all the premium. So it's always a decision which I have to make. But usually when I set the trade, sell the put, it instantly goes. As soon as it's sold, I have another trade placed to buy it back. And usually I use 25 to 30%. So if I sold for $3, I'm having an order to buy it $1. Sometimes I calculate data, but sometimes I just put 30%, and then I already can adjust it if I want to. Okay. And then,
Igor, at the same time, you can do the same thing. If it goes against you, you can buy back again at lower price and pay a little bit extra.
correct. So that's the thing which I'm going just to talk here. So plan B. What happens? Actually, this is very interesting thing. So if I bought it back, can the stock go back down to the same level? So what can I do again? I sell it again. So sometimes I kind of kick the tenants out, like if you compare with apartments, I rent it to someone and then I kick them out and I put another tenant. So it's like you did twice a month, okay? So something like that. So plan B. If the stock goes down, what happens with the premium? Is it growing or is it going down? It becomes more expensive or cheaper? It's more expensive. So first of all, you just can close, same as stop loss with shares, you have a certain stop limit, you say, okay, I'm exiting position, and you put a stop loss. You can do the same thing here. You just buy that put at certain level, say, okay, fine, now I can see that technically it's broke through the support, now it's going to go another $1 or $2 up, I'm not going to wait it, I'm going to just close it, I buy it at whatever price is right now. So just fix your loss. Can you do like that? Definitely. So the second one, let the shares to be put to you. Why? Why would you do that? Because you like the company. You identify the company is fantastic. It has a huge potential to grow. It's growing for the last 20 years. It's good company and it's undervalued. Yes, right now it still keep going down because people are emotional creatures. Market is emotion. Right? Some guys, analysts, they wrote all these bad articles and they drove the downturn even more. So you decided to sit down and wait. So you can buy this, okay? And then you can do what? Just wait until it goes up. It's one thing. And second, what you use strategy? Selling covered calls.
Covered call.
Yes. So you just sell covered. So you move from one strategy, move to another strategy. That's it. And I'm going to show you. Or there is another way. You can execute. It's called roll put strategy. Who knows the strategy? Okay, a few people do. So I'm going to show you that as well. So how it happens. And here you can use different strike prices as well. So let's have a look. Let's, for example, this is company, here you see I sold for $2 in June. And then, 20 days later, it's expired. So that's zero. So I didn't do anything with that. This company, on the 29th of June, it was sold. And on the 18th of July, so it was bought back. So I sold for $2.85 and bought it back for 50 cents. So one month was like $1,500 profit. So then the same company again sold 1st of August and bought it back only 7 days later. Right? So sold it at 1.7, bought it at 50 cents. You see, it's roughly 30% I'm paying back, and it's very quickly. Okay, and fixed some profit here. So MCK, another company, so it's only 10th of August. I sold it 3 contracts and then bought it back and forth 4 days later. So sold for 1.8 and bought it back for 30 cents. Very quick. So I exited the trade. Actually, I'm ready to place this trade because of Donald Trump last night. Not because of Donald Trump, but I mean, market had a pullback. Now I'm actually ready to sell the new again this stock. That's what you do, it's plan A, okay? Now, let's have a look at plan B. Now, you basically understand, if you bought the stock, it's simple. You just sit and wait, after that it's gone. Selling covered calls. I'm sure Pat already covered it, but I want to show you the slide which I showed you last year, okay, when I discovered this company. So at that time, you remember, you see it was Signet, 53 bucks. We could sell $55 call. So the call option, if you remember, who doesn't know what the call option is? Just, do I have to explain? Everyone knows, perfect. So in this particular case, I could collect $3.20 at $55 strike price, so it gives me 5.8% return. That last year. Or I can go for $60 strike price, so it's above, like $7 higher, nearly 15% higher. And I could collect $1.5, which gives me 2.6% return. Or if the share price goes all the way up, it gives me 12% return. So this is very important to understand if you're doing selling puts, how to roll it to another strategy. Understand options in general. Okay? So guys, if you bought the stock, how long can you do this strategy after that? So for example, if the share is not taken from you. Forever. Okay, let's have a look tonight. Same company. The share price only, what? $60. So it didn't grow much. It actually went down and then went all the way up now. So it's about $60. 2 days before it was nearly $53. So right now, if I decide to sell a call with a $61, so it's above strike price. How much I get? $4.70, which gives me about 7% return. That's how many days? 29 days. So that's how you collect cash from selling puts and then selling calls. And you just roll over. As soon as the share is taken from you, what you can do after that? Sell puts again. Okay, so just wait until it goes to support and then sell puts again. Let's have a look. That's another strategy. Okay, so rolling, that's another kind of action. So if you don't want shares to be put to you, for whatever reason, you don't want shares. So what you can do, you can roll it. So you buy the premium back and then you sell for the next month. So how does it work? So imagine that was showing last year again. So and I looked at two durations. So it was 1 day left here, or a couple days here, and then until September. Okay, September, and that's August 17th. So it's 1 month in between. So what happens? Can you imagine if I sold $60 put before? It doesn't really matter what price I received. It doesn't really matter at this particular moment. The more important, how much I'm going to pay for that, it's one thing. And secondly, how much I'm going to receive for the next month. So it's like I'm extending my promise to pay to buy the share. So imagine, I buy here for $6.70. So assuming if I sold it for $4 before, it means I'm going $2.40 in loss if I just do one trade, this trade. But if instantly I sell for the next month, same strike price, just extend my duration. What people pay me? $8.20. So I buy $6.70 and I receive $8.20. Actually, it's one trade. You do it within one trade. You don't have to put this money. Money comes from here. And you end up with a credit. So if you do 1,000 shares, you kind of, there is something happened here. So you received $8.20, you paid $6,700, and you received $1,500 for rolling up. How long can you do this strategy? Forever.
As long as the top premium will be higher than the normal.
Correct.
But you do rolling only if your view is the same, you're still bullish.
Correct.
Because then you don't.
Correct. Correct. So you always consider whatever strategy you're going to use based on all these circumstances. The premium which you receive. If you don't see any premium here, or the spread is too high, bid and ask, and the broker is taking all your profit, don't give it to him. You know, so take everything yourself, buy the shares, and then to sell a call. Because in this case, you probably end up with more money. So let's have a look at the tonight. Same company. Okay, yeah.
Can I ask if there's a crash like happened in February, could you be caught out?
If what happened?
If a crash happened like it did in February in the market?
So, okay, very good question, absolutely amazing. What happens, you always consider, okay, it's kind of opportunity trading. So what do you do if you have a stock? You bought stock, Signet. and you sell put, where is more risk? We already identify you have more stocks. So in this particular case, you have to act in the same type of way. First of all, if it goes down and you believe it's going to go down, so what can you do? You stop loss. You can buy shares, exactly the same. And the good thing about it, when the crisis starts, where people move their money to, good companies or bad companies? Usually what happens, they withdraw cash from fundamentally not sound companies, and they place the money is not leaving the market, believe me. They stay on the market. So the only difference is that they move from one company to another company. And usually the company they are putting to, good, solid fundamental companies. So, and you probably noticed that, like, if you take 100 stocks, and then 95% of them collapsing, you always find what's going on. And usually it's solid, rock solid companies which were undervalued before that, okay? Because people replace them into a good environment in cash. So that's why it's very important. Before you consider that, for example, now if I'm thinking, okay, crash is going to happen, which company out of Tesla, Hershey, or Walgreens I'm going to buy?
Chocolate.
Chocolate, correct. People are stressed, what do? They buy beer and some people buy chocolate, that's it. So I'm investing in chocolate. I'm not going to invest in Tesla. What happens with car industry at this moment? Going to the drain, people don't buy new cars. So you think about your investment before, that's fundamental analysis. That's what most of the time I do. So I analyze this kind of industry. By the way, I'll tell you about next masterclass. I'm going to analyze the company in medical supply industry. So for always interested, usually it's paid. So for you guys, I can do it for free. Okay? So that's what happens tonight. So if you kept this company and we're rolling and rolling and rolling for 1 year, so that's what we're going to do. Tonight, $61, it's 1 day left, so until tomorrow night, you have to pay $1.55, and you instantly can sell for $4.90. Difference, 4,900 minus 1,000, 3,800, which gives you what? 6.2%. Good or good? So how many time do you spend for this trade? 10 minutes. But the thing is that it's not the 10 minutes job. Bruce was correct. When people say I spent like 10 minutes investing in stock market, it means they don't research at all. Okay? I constantly read. On the way here, what I was doing, I'm not going to Facebook. I just read some report, the new which come out. Because why? I love it. Because that's how I make money. Okay. So the next one is summary. Guys, always focus on your profits. Why? Because what you focus on, perhaps, expands. But always remember how to protect yourself. And you do it by what? Only quality company. Don't rely, oh, maybe this company has a huge potential, it's a startup which will take over the world. Wait, 95% of startups, they get into bankruptcy. Don't risk yourself, okay? So be secure investment. Then choosing undervalued companies. Why? Because if it's fundamentally down, the chance that it goes even lower down, it's unlikely. Or at least it's much smaller if you bought a fantastic company which is overpriced. Even great company like Facebook. What happens with Facebook? 25% down. Why? Did something happen fundamentally? Or it's more like emotions. Like, yes, they told that we're going to slow down the rate of growth. They're not going to go down, they're slowing down.
Money just not that big.
Yeah. We're going to grow, but not as fast as before. And it's kind of, you can expect that. Because, like, I mean, when the company is so huge, not every company slows down in their growth rate. So something like that. So try to buy when company becomes undervalued. So learn how to do that. And it could be done by what? How you can identify a company, who knows? If it's undervalued, based on what? What you're looking at. Earnings, right? Or cash flow, or balance sheet, like book value. 3 parameters, and future cash flow. So that's how we do it. Then always sell at support only. I know that some guys, they like to do different way and sell it at resistance for whatever reason when you have to buy it. And have a plan B. And remember, if you fall to plan, we are planning to pay. Okay, guys, thank you very much. So if you have any questions regarding that, please ask.
I have a question.
Yeah.
You sell a support, you sell a put, you're happy with it, the price goes up, let's say 60 days to expiration. The price goes down, bounce again from the support. That's another entry for you. Do you actually enter another position, you sell another put before closing the other one, and you have concurrent position? Or you close the previous one and enter again?
I have a money management. So if I decided, okay, one particular stock is not going to take more than 10% of my whole portfolio, and it's already 10%, I'm not going to hold that position. If I have it right now, it's only 3% of my portfolio, and I have a limit of 10, I might enter it again. So I add it up. But probably I will already exit it before.
Understand.
Okay, so that's the result. Yep.
You look at implied volatility.
Definitely. That's the key, because when the share support, because I always look at fundamental, like at the underlying security, and that's a stock. And I have like basic 3 strategies which you can use. First, just buy shares and sell them when they go up. That's one. Second one, I can sell put. When do I sell put? When implied volatility low or high? High. Why? Because people pay me money for this now. They are happy to pay because they are fearful something happened, bad news about this company, and everyone is stressed, and they are happy to pay me a lot of money. I say, okay, fine. I'm going to take this risk, and I'm going to take money. But what happens if everyone's secure about it and nobody wants to pay me a bit of money? What do? Do I buy stocks or puts or buy calls? Buy calls. Do I buy calls for short period of time or long period of time? Long period of time. Why? Cheap. Right? So I rent apartment for 1 year and then sublet it for like through using Airbnb for weekly sale. That's how I do. Okay, guys, more questions? I just probably just tell you one more thing before I go. If you want to know more about fundamentals of the company, I told you that you see some members of our investment club, and it's just for club members only. I have analytical webinars on a monthly basis. So I just want to show you how fundamentally I do it, because tonight I just jumped over it, and I understand you're trading constantly, and I believe that fundamentals can help you a lot to make your decisions. So guys, the next week on Tuesday, I'm going to have this masterclass called Pros and Cons of Investing in Medical Supply Industry. Also, what I'm going to do, I'm going to identify the company which is good right now for entry. Regardless if you're a long-term investor, it has a huge potential for growth, or if you're going to use option strategies. Okay, and then you're already looking at this, you decide yourself if you're going to do it or not. So if you want to register for that, just go to Facebook, whatever is long, you can take a picture and then find it, or maybe just have my email or phone number, and text me. Can you send me a link? And I'll send you a link. I understand it's quite long.
I have a question.
Yeah, okay.
If you don't mind sharing, what is your normal percentage success rate in trades, and what is your percentage success rates when you sell puts? As in, is it higher or lower than your overall average? And
okay. Okay, so like I have diversified portfolio, so sometimes I buy calls, sometimes I buy shares, sometimes I sell puts. That's the majority 3 strategies. So far this year, I have a couple clients which I run, and the return varies from 32 to 36%. It's already so far this year. And usually it's between 30 to 60 annually. So that's what I do. And
the question was on trading success rates. If you take 10 trades, how many work out when you sell puts?
Okay, I got it. So I didn't analyze like that. So for example, how many put options which I sold, they go into the trade, because they don't go into the trade, because what? I have to buy stocks, and very often I wait just a month and I sell it higher. So it's still profitable trade. Okay, it just was rolled from one strategy to another strategy. Or I start selling calls and I trade cash on that with positions. Okay, so from my experience, I had a couple of trades which went to the drain completely. So it's one of the Russian stocks which called CBS Media. This is kind of bad stock. No, it's fantastic company, by the way. It's excellent. It's multimedia company. Was in the market for many, many years, from 90s. constantly make revenue. But the thing is that Russian government introduced new law, same as already existed in every other country. It's not like a new law which done there. They wanted foreign investors out of multimedia company because they can influence the decision what kind of propaganda to choose. So what happens with stock? Stock was taken from the market. And as soon as they announced it, everyone sold it off. So it was from $8 went to $3. So that was my biggest loss, which I had. And I was so angry because the guy who bought it, he paid for this $250 million for the whole company. And the profit of that company was $15 million previous year. So it's like 2 years later, he paid off his investment. I thought, why don't I have this amount of money and I will buy this company myself? Something like that. So, guys, in another, then I will talk about 2 weeks from now, on Tuesday, it will be another event, which just how to combine value investing and probably cover calls like Pat does mostly. So if you want to attend, it's all online and it's free for you guys, so you can come and visit and watch them. Okay. Thank you very much.
No, just one last for the interest of our members. When you talk about spread, either I didn't catch it or you didn't explain the margin, because that's a very important part of your spread.
All right, from margin perspective, with put options, brokers, different brokers, they would allow to use margin. What it means margin, because you actually don't buy anything, right? So you get in cash. So for example, if you have, if you decided to open the position for $100,000 and you sell put for $100,000. Actually, brokers very often they allow you to do that if you have $30,000 in your account. And it's a weird thing that, so it's 30,000. So can you imagine that if you have $30,000, you can sell puts on the security which worth $100,000. So it's like you leverage yourself how many times? 3 times. But what happens if you're wrong? You have to do what? You have to put how much? $100,000. And here this funny thing happens. Brokers, when you buy something, they wouldn't allow you to have 30%. They usually have at least 50%. So what happens? Margin call. Bam. Instead of making money, you're losing money. So that's why I don't use margin. And actually in Australia right now, like I use Interactive Broker quite a lot. Like I have different brokers, but Interactive Broker is probably primary. They wouldn't allow you to use margin. So it's like, guys, you're secure. If you use Interactive Broker, they wouldn't let you to use margin.
Thanks, Igor. Yeah. At the moment, most of the broker just won't let you do the put option anyway. About 70–80% because they want big margin. Thanks, Igor.
Okay.
Igor?
Yep.
Is that a webinar, the bottom one, how to combine value investing and option strategy?
Yep.
On the 28th of August, is that a webinar?
It's a webinar, all of them webinars. Yeah, so I know because I travel quite a lot. I was 2 times already this year in Turkey for investment conferences. I'm planning to go back to in September to travel to Russia, see Germany this year. So just to speak like that for different strategies. I was invited by hedge funds to speak in front of their investors. When they use the strategies, I want to just explain the strategy, how it works for them, because it gives certain security for investors as well. If they put money in a hedge fund like Pat, when he goes and explains how he controls your money, you kind of feel confident to put money into this type of investor. So, and that's why we've decided to do it online. Like I run, because it's from Wollongong, like you came, and Newtown, and can you imagine poor guys in Darwin? They never have all the seminars, you know. So now they are lucky they can go online and learn it as well. Okay. Thank you.
Thank you, Igor, for a very wonderful presentation. I think I'm going to have so many options, ideas in my mind tonight. I don't think I'm going to be able to sleep well, but fantastic.